Very good, and welcome to everyone. Thank you for joining us here today. What we would like to do today is go through some of the specific tax considerations in the COVID-19 and discuss what are the planning and really moving forward issues that we need to take. Now, joining me today are Joe Stoddard and Andrea Mao. Joe, Andrea, say hello to the crowd.
Hi, everybody.
Hello.
They each have taken on specialty areas, as you can see, tax incentives for Joe and accounting methods for Andrea, and both of which are very, very much a part of the COVID legislation. And they have some things to share with us with respect to how we're going to put that into an application, how we're going to actually take advantage of some of the opportunities that are being created by this legislation. Before we get into those, you can see the agenda here on the table in front of you. I'm going to start with a couple of notes with regard to the employer paid sick and family leave, the Families First Act. This has now been in place for a while, going back to required payments beginning April the 1st, but we continue to get additional information, additional guidance out of the Internal Revenue Service and the Department of Labor as to exactly how this is, or at least how they anyway, expect this to work. Now, as you recall, what the Families First paid leave provisions do is require, if you have fewer than 500 employees, to provide paid sick leave for 2 weeks and expanded family leave for weeks 3 to 12, and to pay that. And this comes in if either your employee actually is sick with the COVID disease, has been told to quarantine as a result of the COVID disease, or is taking care of someone, including a child who needs care because of COVID-19. And the way this is intended to work is the employer pays the employee, and then the feds pay the employer back through a refundable credit. And in case you are self-employed, in fact, there's a provision in there for you. Now, some of the guidance that we've gotten very recently deal with the question of what constitutes the employer? And do we need to combine different businesses in order to determine whether you have reached the 500, or for that matter, remember, if you are very small, fewer than 50 or fewer employees, you can in many ways elect out of this. The Department of Labor typically looks at 4 factors in determining whether or not 2 businesses are supposed to be integrated. No single factor is determinative. According to Department of Labor rules, it's a subjective test. But what is clear is the fact that you have separate EINs is not enough. You really do need to look particularly at the common management. A combination of common management and common ownership or financial control is going to create, at least I think, almost a presumption that you need to be including those together. Now, there was a lot of question as to what constitutes a quarantine. Many thought that when the Congress used the term quarantine meant, they put a sign on your door that said you couldn't go out. Well, it turns out the Department of Labor has a different view. And we see here from the temporary guidance that they have produced that they are equating quarantine and isolation with any sort of shelter in place or stay at home orders. And that includes advice to stay at home, to isolate, to quarantine, and consequently, if you are unable to work because you are required or you have been told don't go out except to go to the grocery store, to take a walk the dog, then you are covered. You are subject to a quarantine, and you as an employee are potentially eligible for these mandated sick leave payments. But, and there's always a but, and this time there is a very big but. The question really is not just, is the employee subject to quarantine? The question is does the employee have work? And if the employee does not have work, if the employer does not have work available for the employee to do, then that is the reason they are not working, and consequently, they are not covered by this provision. And this raises, I think, some real questions as to whether or not we're going to be eligible to claim the refunds. Hopefully, we will get a little bit better guidance on this as we go forward, but this is the state of play as we see right now. As I mentioned earlier, if you have fewer than 50 employees, then you are essentially allowed to elect out of a portion of the Families First mandated leave. And what you can elect out of is the part that says if they have to take care of someone else, including a child. And how do you do that? Well, Department of Labor has given us some specifics as to how you do this. You can see on these are the three magic statements that you see here on the slide. If one of these applies to you, a officer of the business needs to certify this. And how do you certify it? Well, it looks like you put it in writing, you date it, you get the officer to sign it, and you put it in a drawer, because the DOL does not want it now, although they may be asking for it somewhere in the future. Healthcare providers. There was unlike the fewer than 50, healthcare providers can be excluded entirely from this. And we have a very, very broad definition of healthcare providers for this purpose, because it essentially includes any employee of a business that is involved in providing healthcare that connects with COVID-19. However, question has come from a number of our clients, at least, that says, well, wait a minute, we have some that we really need to come to work. We have some we do not specifically need to come to work. Can we treat those two groups differently? And the answer does seem to be yes. In the preamble to the Department of Labor temporary rules, we see language which would seem to support this as an approach. Governments. Governments are also subject to the Families First Act. And in fact, governments are subject to the Families First Act and the requirement to provide the paid leave without regard to their size. And beyond that, they are not eligible for the credit that is otherwise available for a private employer. So in this case, the government is going to have to provide, but is not going to get the compensation that the others will get. How do we get the credit? Well, and we'll see us go through this again in the context of some of the other provisions. If you owe the government money, don't send it in. If after you don't send it in, you still have some credit coming to you, then the IRS has promulgated Form 7200. Supposedly within 2 weeks, they will get you a check or get you a direct deposit, more likely, that refunds any excess over the amount that you offset your payments in. Now, yesterday, April the 30th, was the deposit date for many of us because of the quarterly deposits. And I think that's going to take us to our first polling question, which is, were you subject to Families First? And if you were subject to Families First and actually paid something under Families First, how did you handle that in the context of the first quarter payroll tax report that you filed yesterday? Keep in mind, as long as the credit is coming to you, it does not need to be from a period that the report relates to. So in fact, if you had a credit for wages paid during April, then the fact that the first quarter payment only applies to January, February, and March does not prevent you from reducing that payment in order to recover the benefit of your Families First payments. Let's take another minute here. Anybody who wants to use the last, we will not disclose anything. The results will be hermetically sealed, put in a mayonnaise jar under Funk and Wagnall's porch, never to see light of day again. And with that, why don't we take a look at the results? And I'm going to turn things over to Joe to talk about the employee retention credit. Joe?
Thank you, Mel. And just a repeat, really appreciate everyone joining us today, and excited to talk about the employee retention credit. So I guess before we dive in too far, obviously with the CARES Act legislation, a lot of the attention and focus, and deservedly so, has been on the PPP loans. And so I want to start by saying, if you're taking a PPP loan, or you're planning to take a PPP loan, then you are not eligible to claim the employee retention credit. Now, so we're purposely not diving into PPP too far today. We're focusing more on the tax issues, but we should mention that just last night, the IRS issued a notice 2020-32, that basically said, despite the fact that Congress said that the PPP loan proceeds would not be subject to tax, they turned around, and the IRS's view is that the deduction, that your deductions will need to be reduced by any PPP funds that you use that are subsequently forgiven. So a little bit of a surprise to some, because it seemed to go against the intent of Congress on making the PPP loans tax-free. Mel, I don't know if you're still unmuted, but I am curious, since you've got your hand on the pulse in Washington, is there a chance that Congress will maybe deal with that issue in subsequent legislation?
I think there's a very, very good chance that Congress will deal with this in the next round of legislation. Obviously, until that happens, we can't count on that. But Congress clearly was intending this as a subsidy. I think the fact that they provided a statutory exclusion from 118 from the contribution to capital rules to indicate that it was intended to be a subsidy, to then turn around and apply Section 265, which is what the Internal Revenue Service feels does control this. And actually, I think in the notice you mentioned, they included a fairly extensive legal defense of the position they're taking, which likely would be upheld in court. I think this definitely puts the ball back in Congress's court. My understanding certainly is that Congress intended this to be a subsidy, intended it to be a grant of funds. And so I think that is something that I would expect to see addressed, probably as a technical correction with a retroactive effective date in the next round of COVID-19 legislation.
Very good. Thank you, Mel. And I know, and it's tough, right, for a lot of companies that are, especially if you have not yet received a loan, or maybe you have received a PPP loan, and some of the statements and FAQs that were released over the past week that allow you to then return the loan by May 7th if you don't think again, this is more of they seem to institute a new rule that you didn't have access to additional capital. But lots of moving parts, and if you're choosing between PPP and ERC, a little bit difficult, since we don't have perfect guidance in either area. But let's dive into the ERC. So for those who are not yet familiar with it, this is a refundable credit up to $5,000 per eligible employee. What the term refundable means, and we'll talk to this in a minute, but it first offsets the employer portion of Social Security tax, but then anything above and beyond that is refunded. So doesn't have to carry forward and offset future tax liability. The first test in figuring out if you're able to claim the ERC is looking to see if you are an eligible employer. And there's two different ways to be classified as an eligible employer. You either need to show that you've had a full or partial suspension of the business due to a governmental order, or that you've had a significant decline in gross receipts compared to the same calendar quarter of 2019. So that you would trigger that gross receipts qualification if you're more than 50% decline. So if your Q2 gross receipts are more than 50% less than Q2 of 2019, you would then be eligible to claim the ERC. From there, if you are an eligible employer, the next test is around the company size, and there's different ways there's different costs that can be included depending on whether you're above or below a 100 employee threshold. And that's 100 full-time employees based on 2019 average. So we'll talk about some more specifics on that here in a second. The credit is, on its face, is a fairly simplistic calculation. The credit is simply 50% of qualified wages. However, with most things in the tax law, especially with the CARES Act, the more you look, the more questions that are raised, and the more layers of the onion you need to peel back. I talked earlier about the refundability portion. In terms of qualified wages, the sort of the base wage you look at is the Social Security wages. So the W-2 Box 3 wages, but you're also able to include an allocated share of the employer's healthcare expenses. Those qualified wages do max out at $10,000, so that's how you get to the $5,000 max per employee, 50% of 10,000. There is a rule in there that the wages used for the ERC can't exceed the amount that employee would have been paid in the prior 30-day period. So if you're a company owner, you can't give if your child works for the company, you can't give them a big raise and then take the employee retention credit on the increased wage amount. A few important notes. Tax exempts can qualify for the credit, so there's an opportunity there. There was some initial uncertainty around whether you could qualify a tax exempt under both the gross receipt or this partial suspension of business rules, and that was clarified just recently that either you can classify a not-for-profit under either of those tests. There is no requirement to maintain a certain level of employment or payroll levels, so a little bit different analysis than the PPP program in terms of the forgiveness model. And there's also no overall dollar limit on the amount of credit you can claim. So how to claim the credit? And again, this is really a repeat of what Mel said earlier. You can immediately get the cash by reducing your federal tax deposits. And that can be done periodically, right, throughout the quarter. So if you're making a federal tax deposit every 2 weeks and you know you're going to be able to claim an ERC, you can reduce the amount of credit the amount of that deposit by the amount of the anticipated credit. You can also file that 7200. That's an optional step. So some of our clients are figuring that there's more certainty in just continuing to reduce their periodic federal tax deposit as opposed to submitting the form and hoping that the IRS is able to process that in the 2 weeks that they promised. I should mention that the federal tax deposit includes not only the employer portion of payroll taxes, but all of the buckets, right? So the withheld federal taxes as well as the employee payroll taxes, all of those can be withheld if you're anticipating a credit. And then again, you report them. The 941 for Q1 that was due yesterday, that was not updated with the credit. So this will all the Q1 and Q2 ERC will be reported on the revised Form 941 that will be coming out for Q2. So there's a lot, like everything in the CARES Act, I talked about this earlier, but there's a lot of gray areas with how to apply the rules. And probably the biggest question that we've been getting is how to apply this whole concept of having your operations partially suspended. First off, your operations have to be partially suspended due to a government order. So what is a government order? And this guidance just came out a couple of days ago, basically saying that it's a fairly broad definition of a government order. However, it does not include statements that are made during a press conference or during an interview. It really needs to be more of an official order to be able to qualify as a government order. Other questions have arisen around, again, this whole idea of partial suspension. If, for example, if I'm an essential business, is it even possible that I could argue that I've had a partial suspension? And I think the FAQs that came out earlier this week does leave that possibility open. And some specific examples in the FAQs that came out. One was, if I'm an essential business, and in this case, I think it was an auto parts supplier that's deemed an essential business in a particular state, even if they're able to stay open and operate normally, if they have a key supplier that has been partially suspended and they're not getting in the supplies that they need, then that there's sort of this domino effect, right? Where the government order and the impact it had on their supplier can then make that eligible business also eligible under the partially suspended test. The other thing I thought was helpful in the FAQs was that if a government order limits the hours of operations for a business, that can constitute a partial suspension. I should note that there were a few things that were considered to be not partially suspended in the FAQs, and probably a little bit more of a narrow definition than we were hoping for on this side. And there was basically, if a business can continue to do all of the same functions via teleworking, then they would not be considered partially suspended. And also, it's not enough to say that your customers have to stay home under a stay-at-home order. That does not, by default, on its own, make you a partially suspended operations. I sort of glossed over this earlier, but for companies that have over 100 full-time employees, you can only claim the employee retention credit for wages paid for time that is not spent working. If you're under 100 employees, you can claim the credit on all of the wages paid, but if you're over, you can only take the credit on wages paid for non-work time. So there's some examples in the FAQs about how you can allocate and determine how much time is spent working and not working. So you're allowed to, it's not an all or nothing. An employee doesn't have to be completely shut down in order to claim the credit on part of the wages paid. But saying that, you can't simply look and say, well, that employee is less productive, therefore I'm going to take the credit on part of the time that they're not being productive. It really has to be more of a, they don't have assigned work to do and they're still getting paid situation. The FAQs also took a very narrow view on some of the different types of payments. For example, severance payments were specifically excluded, at least in the IRS's view of that. I should mention that IRS FAQs are not official regulations or guidance, so you obviously decide how to apply the law, but they are helpful to kind of know how the IRS is going to view some of these things. The other part that I felt was a pretty narrow view, a reading of the statute, was that IRS took the view that if there's any healthcare costs that are paid to furloughed employees, those are not qualified wages unless some level of wages are being paid to those employees. You know, so you would think you could plan around that and pay a very nominal wage to your furloughed employees. And then if you follow the FAQs, then you'd be able to include 100% of the healthcare costs. So again, I don't think that really follows the intent of the statute, but we'll see if any additional guidance comes out on that issue. So who should be at least considering the employee retention credit? Again, not taking a PPP loan. There's a question that's in the Q&A, and we've had the same question from some of our clients, is what if I return my PPP loan? And we don't have specific guidance on that question yet. You would think that if the funds that you were given for a PPP loan were returned and they go back into the pool that then can be loaned out to somebody else, that you would be eligible for the ERC. If it's really treated more like a repayment, you know, the rules we have do say that even if you've got a PPP loan and repaid it, you're not eligible for ERC. So it really needs to be, I guess, again, we're waiting for guidance, but we're hopeful that the IRS will allow those employers that return their PPP loans to be able to claim the ERC. So keep your eyes and ears open on that one. And again, you've had to have some impact of COVID-19 on your business. You can't just be chugging along business as usual and be able to benefit from the ERC. Are you continuing to pay? If you're over 100 employees, you also need to be looking at whether you continue to pay for full-time work and not having enough work assigned to keep everybody busy. Companies that have done layoffs or furloughs, and you paid, you know, some amount of wages, maybe 2 or 3 weeks versus of wages before the layoff or furlough came into effect, those payments would likely be eligible, but again, severance would not. I listed some industries. Obviously, this is not an all-inclusive list. Fairly broad industry application. A couple that I put potentially, in most states, I think banking and ag would be considered essential businesses. So you really need to be able to show that that you were still partially suspended. Again, probably a gray area example, but if you've got a bank that's had to close their lobby due to government restrictions, but are continuing to provide drive-through services, I would think you've got an argument that your operations have been partially suspended, but again, one of those gray areas we're still waiting on guidance from. There's a couple of examples here. Again, it kind of just illustrates how quickly the dollars can add up. For companies less than 100 employees, it's $5,000 potentially per employee. So if you can qualify, if you've got 85 employees in this example, your tax credits, this is dollar for dollar, is $425,000. For larger companies, in this example, 650 employees, you've got to look at the employees that are working or paid but not providing services. In this example, if you're able to qualify all 230 employees that were not fully providing services, you can max that out at just over 1.1 million. So the dollars can add up quickly. I'm going long on my time, so on this slide, I'll just mention that there's lots of incentives and there's interplay. So you obviously can't just look at the ERC in a vacuum. We've got to look at the credits that Mel talked through earlier. We've got to look at if you're taking the WOTC or other payroll credits, and there's some interplay there. So some things to consider as you're going through the mechanics of claiming the credit. And then finally, I'd be remiss just if I didn't mention, hey, Bailey would love to help you with your employee retention credit. If you think you might qualify, we can certainly just be available to answer questions and be a sounding board. We can provide consulting to review your calculations and help you through the process. Or a lot of our clients would, take in kind of the option to outsource it. We can certainly gather the data and do the analysis and help you fully claim and also document the credit. So feel free to reach out to me directly if you are interested in talking through any of those options. With that, we're to our next polling question. And I probably don't have time to go through. I have a few questions in the Q&A. Let's see if there's any. I address one of them. And I'll respond maybe in writing to a few more of these as we go on. That's probably the best way to do this. Somebody asked, is the ERC only available if you have your employees stay home and continue to pay them? Or if you find work for them but not in their normal duties, can that be claimed? So if you're over 100 employees, whether they're at work or at home, if you assign them new work and pay them for that work, then you cannot claim that time for the credit. But let's say you have an employee that's not able to do their normal job, you find work to keep them busy half the time, the other half you would be eligible to claim the credit if you're paying them their full salary, if that makes any sense. I think with that, because of time, we'll move on, but I'll work on answering some of these other questions through the Q&A function.
All right, great. I think, Joe, actually, you had the payroll tax deferral.
I got ahead of myself, didn't I, Andrea? I apologize. We'll just touch on this one really fast. I think most of you are probably aware that there's an opportunity to defer your payroll tax. So essentially what you can do is not pay your the employer portion of Social Security tax. That deferral period started at the end of March and runs through the end of the year. And then it's an interest-free but also application-free loan. 50% of that is due at the end of 2021, and the other 50% would be due at the end of 2022. So if you're needing the cash or just want access to kind of that source of cash, this is a great option and it's really open to all employers. There's not the limitations you have on some of the other provisions we've talked about. However, if you're taking a PPP loan, you're eligible to do that deferral until you get the loan forgiveness. Once you have the loan forgiveness, you're no longer eligible to defer the employer payroll taxes. And again, there's a tax deduction that you're likely going to have to defer until you make those payments as well. So yeah, that's another thing that should be, it's relatively straightforward, but should be on your radar if you're needing the cash.
Yeah, it certainly is a good way to save some cash now, even if it is just an interest-free loan, but still keeps cash in your pocket for today. And Joe, my name is Andrea Mao. I'm in our accounting methods group at Eide Bailly, and I'm going to talk about some of the modifications that the CARES Act made to the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act, as I'm sure most of you recall, was passed at the end of 2017, with most of the provisions kicking in January of 2018. There were a lot of taxpayer favorable components to that: the reduced corporate rate, the 199A deduction, simplified accounting, more bonus depreciation, more 179, all sorts of great things for taxpayers. But there also were some revenue raising provisions in there that were put in there to avoid this particular piece of legislation generating too large of a deficit. And then there were also some technical and drafting errors because of the way this was passed in such a short window of time. There were a number of issues with the language in the statute. And the CARES Act really takes aim at those last two things. They looked at the revenue raising or non-taxpayer favorable provisions, made some modifications, delayed some effective dates, and then they addressed a few of the more significant technical and drafting errors that were in the original legislation. Perhaps one of the biggest benefits that the biggest modification benefit was from the net operating loss rules. Prior to the Tax Cuts and Jobs Act, businesses could carry back a net operating loss 2 years and forward 20. The TCJA wiped that out and said no more carrybacks. You have to carry it forward, but you can carry it forward indefinitely, and you can only use that NOL to offset 80% of your taxable income. The impact of that provision is that even if you have millions and millions and millions of dollars of NOLs, you're always going to end up paying a small amount of tax to the government on 20% of your taxable income. So the CARES Act, what they did there was they changed the rules for NOLs arising in 2018, 2019, and 2020 tax years. So the 2018 returns you filed last year, the 2019 returns we're looking at now, and then 2020, we are allowed to carry those losses back 5 years. And what that gives us is the ability effectively to monetize those losses now. Carrying those things forward only generates a benefit in a future period where we have taxable income. This way we can use those losses and go back into years where we previously did have taxable income and have actually made payments to the IRS. And also the NOLs can offset 100% of the taxable income for tax years beginning before January 1, 2021. So now we can use our NOLs to completely eliminate our tax payment obligation. So what's the big benefit here? Well, it's cash now. I can use my current period losses, monetize them by carrying them back to prior years. And to make it even better, the TCJA reduced a lot of the effective tax rates. It reduced the corporate rate from 35 to 21. It reduced some of the individual rates. And so most people right now are subject to a lower effective tax rate than they were prior to January 1 of 2018. What we can do now is take a loss we're generating in the current period that may only be worth 21 cents on the dollar and carry that back into a prior year where we can get a benefit of 35 cents on the dollar, as long as we had income and taxable income that we paid on in 15, 16, 17, or even go all the way back to 2013 for our 2018 losses. We can also look at making accounting method changes to increase our operating losses. So accounting method changes are issues relating to the timing of recognizing revenue and expense. So what we can do is consider accelerating some expenses into the current year to increase our loss, which that we can then carry back and use that to obtain the cash back for the taxes that we've paid in the past. We can look at deferring income. We can also look at, are you likely to have a loss in 2019 or 2020? When would be the best year to take these deductions? When are you going to get the most value from them? The IRS has expanded the opportunity to file tentative carryback claims. Typically, that is only open for a year after the end of the tax year, but they've extended that through the end of June of this year to make those carryback claims. And they've also started accepting faxed forms. So I guess they've joined the late 20th century now, and maybe not the 21st, but we're getting closer here. They will accept faxed versions of those forms, but only for these years and probably only for the limited window of time that they are limited in their ability to work in the office. But don't don't get too excited. There are unfortunately some downsides to this. When we carry back an NOL to a prior year, we're forced to recompute all of the tax items in those prior years. So when we're going back to pre-2018 years, there was the 199 DPAD or domestic manufacturing deduction. We had AMT at both the corporate and the individual level. There were tax credits claimed in prior years. Section 199A could have been claimed in 2018. All of those calculations will need to be redone based on our new taxable income after NOL carryback. And losing some of those deductions, losing the DPAD deduction is a permanent loss. The DPAD doesn't exist anymore. If we have to pay back that, that's a permanent loss. The other thing to keep in mind is there are very significant and international implications here. For those taxpayers who have FDII, GILTI, transition tax, or BEAT obligations, carrying these losses back can impact all of those calculations in the prior year, and some losses from GILTI and foreign tax credits and things aren't always able to be carried forward. You could potentially lose the benefit of those items based on when this is carried back. The corollary to the NOL rules for pass-through entities were the 461L pass-through loss limitation rules. And those rules basically said that taxpayers can only use $250,000 or $500 for joint filers of loss from a business activity to offset non-business income. The remainder of the loss gets carried forward. So historically what had happened was if you weren't subject to other loss limits, passive loss, at-risk, basis issues, you were actively involved in the trade or business and generated a large loss, you could use that loss to offset investment or portfolio income. Well, not entirely anymore. Now, your ability to offset that income is limited. The CARES Act came in and said that instead of that provision being effective on January 1 of 2018, it is now effective on January 1 of 2021, meaning that any losses generated during 2018, 19, or 20 can be used in full to offset a taxpayer's tax liability. Again, similar to the NOL, we don't have a situation where we're going to have large losses yet still be required to pay tax on some amount of our income. One interesting note here, though, is that this provision doesn't appear to be optional. So what the IRS did is they went back into the statute and changed the effective date from January 1, 18 to January 1, 2021, meaning that arguably a taxpayer who applied these rules in 2018 or 2019 was not allowed to do so because the rules did not apply in that year. And so if we did have a situation where someone limited a loss on a 2018 or 19 return, I think we need to advise them to file amended returns and stop taking into account 461L. Otherwise, they could run into some issues down the road with the IRS on exam. One of the other limits in the TCJA was on the deductibility of interest expense. It limited deductible interest expense to the sum of 3 items: interest income, 30% of adjusted taxable income, and floor plan financing. Adjusted taxable income for 2018-19 for the next few years is effectively an EBITDA number, meaning we take our taxable income, add back our depreciation and amortization. The CARES Act came in and said, okay, for non-partnerships, for 2019 and 2020, we're going to adjust that ATI limitation from 30% up to 50%, meaning that we've moved the ceiling on the amount of interest expense you can deduct, so more people should be able to deduct more of their interest. Partnerships were only allowed to modify that computation for 2020. This is the result of some kind of unusual amended return rules that came out of recent changes in partnerships and the BBA Act. So what they're trying to do here is avoid the issue of partnerships needing to amend their returns. So partnerships will still apply the 30% of adjusted taxable income for their 2019 calcs, but they've adjusted the rules so that those suspended interest expense deductions can get taken more quickly in 2020. And looking forward to 2020, taxpayers have the opportunity to use their 2019 adjusted taxable income to complete their 2020 interest expense limitation. So for those of you who are projecting much lower taxable income in 2020, this will help to take the edge off of that a bit. Under 163J, there were a few elections that were available for taxpayers to choose to be exempt from the interest expense rules, specifically those taxpayers engaged in real estate and farming businesses. And the trade-off for that election was that they were required to depreciate some classes of assets using the alternative depreciation system and no eligibility for bonus depreciation. So what that did for those asset classes was extended your recovery period, and you lost the ability to claim any bonus depreciation on those assets. Under the TCJA, that election was required to be filed with the return in the year it was to be effective. You cannot go back and amend returns and add these elections. And they were also irrevocable, meaning that once you decided you were going to be a real estate business and not apply the 163J exceptions, you are stuck with that forever. The CARES Act and the IRS since then has issued a revenue procedure that allows taxpayers to reconsider those elections. It allows taxpayers to consider, well, maybe now that that limitation has gone from 30% to 50%, I don't need this election anymore because now my interest is fully deductible without having to make this election, and then I don't have to slow down my depreciation. Alternatively, you may come to the conclusion that you're better off making this election and giving up some depreciation based on what you're seeing that has happened since you've made that election. Those are now allowed to be done through amended returns for 2018, 19, or 20. And in addition to adjusting the interest expense on those returns, taxpayers will be required to adjust depreciation. And then again, similar to our NOL rules, will need to recompute the full return and take into account any other collateral adjustments that result from the making or revocation of this election. And the elections generally for the 50% of adjusted taxable income for 2019 or 2020 and the ability to use 2019 ATI rather than 2020, those elections are made by doing. So taxpayers take that position on their return, no specific disclosure or statement required. And perhaps one of the most popular, or maybe not popular, most famous of the issues with the original TCJA was related to the qualified improvement property depreciation rules. Qualified improvement property are interior non-structural improvements to buildings that are made after the building was placed in service. So these are costs that companies would typically incur in connection with renovating or remodeling their spaces. It's called the retail glitch by quite a few people because it impacted the retail industry disproportionately. So under the TCJA, the intention was that this qualified improvement property would get a 15-year recovery period and be eligible for bonus. However, that got left out of the statutory language, which forced us to default to depreciating these assets over 39 years using the straight line method. The CARES Act came in and retroactively fixed that correction, meaning that all assets placed in service on or after January 1, 2018 that constitute QIP are now have a 15-year recovery period, and assuming they can meet the other bonus depreciation requirements, they're eligible for 100% bonus. And similar to the pass-through loss limit rules, the IRS is taking the position here that 39 years, using a 39-year recovery period for QIP is an impermissible accounting method. Using that opens you to the possibility of permanent basis loss as a result of the basis reduction rules. So taxpayers who did place assets in service in 2018 and 2019 that meet the definition of QIP need to go back and adjust the depreciation on those assets to avoid any concerns with the IRS. How do we fix that? We have two options. You can amend prior year returns. You can do this for 18 or 19 regardless of what has been filed. But again, we're going to have to recompute all of your taxable income using the new depreciation recovery periods. And then the second option is to file a Form 3115. This is filed with a current period return, meaning that the impact of the additional depreciation will flow entirely through your current year return. You will not go back and recompute the prior years when you place this in service. Everything runs through in the current year. And we have a new automatic accounting method change procedure for this, change 244, that provides some streamlined filing provisions for this. And these can be filed up until the extended deadline for returns. So for a calendar year taxpayer, these could be filed through September 15 or October 15. And the revenue procedures to 2020-25 also gave us an opportunity to modify certain depreciation elections. So the way the bonus rules work are if you place assets in service in a year that are otherwise eligible for bonus, you're required to take it unless you make an affirmative election out. And if you make that election, then each class of property, 5-year, 7-year, 15-year, is exempt from or not required to take bonus depreciation. The elections we are now allowed to modify are to make that election late, so we can go back and say, you know what, I don't want bonus depreciation on my 2018 assets, or I could revoke that. If when I filed my 2018 return, I thought I didn't want bonus, but now that I can use that as an NOL and carry it back, maybe I do. Maybe I want to change my mind on that. So for the next few years, we are allowed to make and or revoke those elections through 3115s and amended returns. After that period, they go back to being private letter ruling requests, which carry filing fees and pushing $30,000 in some situations. So definitely something we need to be focused on for the next couple years. The corporate AMT credit, the TCJA repealed the AMT effective January 1, 2018 and allowed taxpayers to recover their prior credits over a 4-year period from 2018 to 2021. The CARES Act came in and shortened that period. The new rules allow us to recover those credits over 2 years instead of 4. So by the end of 2019, taxpayers should have been able to recover any unused AMT credits that they had as of the date of the TCJA. So putting all this together, what do we have? What we have is a very complex modeling exercise to try to identify which of these provisions and what is the best way for each individual taxpayer to benefit from this. This will need to be, it's a facts and circumstances analysis that will need to be done on a taxpayer by taxpayer basis. We're going to need to take into account, you know, prior year tax issues. Did I have income? What deductions did I claim that I might have to give back? What about the current year? Am I in a loss? Do I need deductions to offset my income? Do I want to accelerate an NOL into this year? What about the international rules? How do those play in with all these federal provisions? How badly do I need the cash now? What are the fastest, easiest ways for me to get cash if I need it now? Is it filing, amending returns? Anything I push into 2020 is likely not to get me any cash now. That's probably going to impact me primarily next year. What about the permanent tax savings? I can go back, any losses I can carry back to pre-2018. I've got a higher effective tax rate. That's permanent money that I otherwise wouldn't be allowed to recover from the IRS. Do I want to give that up? The procedural challenges. Under some circumstances, filing amended returns is not particularly feasible, especially in large pass-through entities. So they may want to take actions that don't require amended returns. So all of these things need to be considered before deciding how best to move forward, because there are a lot of moving pieces here. And then our third polling question, have you started this lovely modeling and analysis process for your current and prior year taxable income? One of the questions that came in, the NOL carrybacks, you do have to go back the full 5 years and roll forward from there. So if I have a loss in 2018, I have to go back to 2013. I can't handpick which year I take that loss in. And then I think I turn it back over to Mel.
Thank you, Andrea. And that is certainly a number of interactive items that have to be taken into account. And that's even without dealing with the other questions of how we access the specific provisions there. Just in a few minutes that we have remaining, I wanted to touch base. One area that we have not touched on previously is the issue of, well, where's my stimulus check? This is a good question. Your stimulus check is in the mail. Hopefully that is not actually the case. Hopefully the stimulus check is already been deposited. The key items here, if you need to check up, are really the Get My Payment tool that is available through the IRS. Questions are dealt with under the so-called Get My Payment FAQs. The IRS insists that 120 million of the 170 million that they expect to pay have gone out. And that may mean, because this also includes some of the paper checks, that just may mean they're in the mail. They have also said that they will be sending a letter that is supposedly going to indicate what they have done with your stimulus payment, assuming that you are entitled to one. If you do not receive a letter, then checking the so-called Get My Payment tool is probably your best source of access. That is, unless the IRS literally has no record of you at all, and that includes there's no social security, there's no nothing. The Get My Payment tool is really where you have. Let's talk briefly about some of the other provisions that were in the CARES Act that deal specifically with individual opportunities to get some hands on your cash. The legislation creates a new concept called the coronavirus distribution. This is available from most any kind of defined contribution plan or IRAs. And what this says is that a distribution made during the calendar year, if you can meet one of the three standards, you were diagnosed with COVID-19, you have a spouse or dependent who is so diagnosed, or you, quote, experience adverse financial consequences resulting from quarantine, furlough, being laid off, reduction in work hours, or being unable to work because of a lack of child care related to COVID-19. If you can fairly state that, then you are eligible for coronavirus distribution. And what these are really quite open. We do have a $100,000 per individual cap. That includes all plans that you might be able to try and take money out of. But the key here is the repayment system. If you repay this, normally if you repay money within 60 days that you take out of a qualified plan, we don't tax it. The government does not tax it. Under the coronavirus distribution rules, you have 3 years from the date of the distribution to pay it back. And if you do so, it will be considered the equivalent of a trustee to trustee transfer. In other words, it will not be taxable. Now, does that necessarily mean that it has to go back in the same qualified plan? Apparently not. So for instance, if you take money out of a 401k and within 3 years, meet the standards and within 3 years move it into an rollover IRA, then it appears that you would not be considered to have a taxable withdrawal. Now, if in fact you do not get it repaid, do not get it redeposited, then it is included ratably in income over 3 years. We don't know what happens after year 1 or year 2. Since you have the full 3 years to redeposit, do we need to treat a portion of it as taxable and then file an amended return to get that back? Unfortunately, we're awaiting additional guidance on this. In addition to coronavirus distributions, there is also a new rule for coronavirus plan loans. Essentially, these are the old plan loan rules, 401k, 403b, 457b, but the limit has been taken up from to 100% or 100% of the vested balance. And this does not go back to January 1. This begins with March 27, which is the effective date, is the enactment date of the CARES Act. All repayments, and this applies to any, are suspended during 2020. So essentially what we've done is we have taken the normal 5-year repayment term and turned it into a 6-year repayment term because we're not going to count 2020. Required minimum distributions have been suspended for 2020. That is all required minimum distributions. It includes the beginning distributions that were otherwise required by April 1st because you went over the age limit. Now, with regard to all of these changes, you need to be careful and determine if you are sponsoring the plan, whether or not the plan documents cover things that they now need to cover. And that's something that as sponsors, we're going to need to go back and take a look. Fortunately, we get some special relief in the need to actually amend the plan documents. The amendments have to be adopted before 2022. by the end of 2021. But so long, and that is okay, so long as the plan behaves as if the amendments had been adopted during the intermediate period. Are we done with COVID-19 legislation? Almost certainly not. What is next? The expectation is that we're going to see another round of legislation, probably with some additional stimulus payments, with additional PPP loans. The PPP loan system is likely to be modified this time, so it would be more small business focused. The Democrats are demanding that money be provided for state and local governments. The Republicans are demanding that some form of tort protection be added to whatever the legislation that comes up next. I would add to that, as we've seen going through today and some of the other seminars you may have sat through, there's still a lot of areas where a little cleanup of CARES or Families First would be appropriate, particularly the new guidance with regard to expenses paid from forgiven PPP loans. I think that is Congress is likely to take another look at that as we go forward. So many people are now working from home. There are going to be issues that provides maybe some better incentives or better fixes. Okay, we need to finish, and we're going to go to the last polling question right now. What do you think is going to happen with regard to the COVID-19? And please click in and give us your thoughts. And I want to thank you on behalf of Joe and Andrea and everyone else at Bailey for joining us here today. If people would like to stay on, I think we can probably answer a couple of the questions that have come in.
Okay, we can do that for about for a couple minutes. That is no problem.
Sorry, I do unfortunately have to jump off, but if there are other questions specific, feel free to email me those later.
Right.
I'll follow up. Thank you.
Sounds good. All right. Well, Joe and Mel, we actually do have a ton of people dropping off, so let's just answer those questions.
We'll answer
offline.
those online then, and I think we may provide the answers pretty much to everyone, correct?
Yes, that'll be fine.
Very good. Well, again, thank you all, and we look forward to talking with you the next time.